Good morning. My name is Damola Owolade. I am the manager of the SADC Financial Inclusion Program at Finmark Trust. I'd like to thank the Angolan Banking Association for providing us the opportunity to speak on the subject matter around the digital transformation of financial services, specifically in Africa, and touching on examples within the Southern African Development Community region. My presentation has the following overview. I will start off speaking about Finmark Trust. I'll be giving some context regarding the impetus that has led to the need to digitize and transform financial services. And then I will speak on some of the financial services provider types and models, business models that have actively moved towards transforming the way in which services are being delivered. And then I will talk to the impact of the digitization of financial services from the perspective of a regulator, from the perspective of the financial services providers themselves, and from the perspective of the customer. So for those who are not aware of Finmark Trust is a financial sector deepening trust that was set up by the Foreign Commonwealth and Development Office, the FCDO, in 2002. We are currently 20 years old. Finmark Trust's purpose is to make financial markets work for the poor by promoting financial inclusion and regional financial integration. And in more recent years, we've moved towards looking at the linkages between financial inclusion and real economic outcomes, particularly those that align with the UN Sustainable Development Goals in terms of poverty reduction, access to basic services. In reaching this vision and mission and mandates that Finmark has, it has been important for us to work in partnership with regional bodies such as the Southern African Development Community Secretariat, the SADC Banking Association, the SADC Committee of Central Bank Governors, and at country levels, we would work with financial sector regulators such as central banks, financial service providers, the Ministry of Finances, Ministry of Trade and Investment, and all key economic ministries, including national statistic offices, where we collaborate with the statistical offices in generating insights that are nationally representative in order to have a better understanding of the demand side from a financial inclusion perspective. So now, given an overview of the digital transformation process and in terms of the impetus that has led to the digitization of financial services. Just to anchor this on some definition issues, when we speak of digitalization in financial services, we're not just talking about digital financial services itself, or the access perspective in terms of digital access to financial services. And it's also not just about the outsourcing and use of technology by FSPs. What we're talking about is the effect of digitalization on the processes that underlies financial services in terms of the systems that need to be in place, in terms of the way in which information is generated about customers, in terms of the type of platforms in which FSPs use in fulfilling compliance, regulatory compliance, we're also talking about the impact of the mainstreaming of digitalization in the economies of the world. That is, the evolution of trade and commerce and how that has taken on a digital format, especially in a post-COVID world where a lot of businesses are moving onto digital platforms. And to what extent has financial service providers reacted to that? And obviously, the effect on the customer's acceptance and customers being persons and businesses and their particular demand for digitization. And all these come to bear when we're thinking about the digitalization or the digital transformation of financial services. Now, speaking to the drivers of digitization, one of the key issues here has to do with the new realities that's unfolding, specifically on the increase in communication capability and computing power. If you think about some of the devices that we have, our iPhones, our Android phones, and the technology that supports these ICT infrastructure, the increase in the availability of data, which stems from the digital platforms that consumers are already using, which then provides information on location. It provides information on what people usually would search for on the internet, will provide information on your consumption patterns. Essentially, we're living in a world where the use of digital devices has led to the availability of massive data. The digitization obviously requires data, and more data availability has made it actually quite easier to drive digital transformation. Another aspect that has been driving digitization is the ease in the process integration within organizations. So the move towards standardization and the availability of open source systems and technology and data availability has actually enacted and moved organizations towards increased process integration, which obviously then drives digitization. Furthermore, we've also seen an increase in the availability and scope of technology and data-based services. So if you think about artificial intelligence and machine learning, cloud computing, APIs, etc., would lead to digitization and obviously the acceptance and demand by consumers. The last two generations are technology generations, and obviously this then necessitates the need for a digital transformation. Now, just to give some data around the level at which technology has enabled consumers in Africa to be in a position to engage either with digital platforms or digital financial services. And as you can see, some of the latest data from the GSMA shows that the mobile phone penetration in Africa is about 515 million people. And when we think about mobile penetration, comparing Africa to the world, internet access at home for Africa is 14.3% compared to 57.4% of the world. Individuals using internet, we have in Africa 28.6% compared to 51.4% in the world. And if we provide some sort of gender perspective on this, we can see that 20% of women in Africa are using mobile devices compared to 48.3% in the world. So just to go back to the economic evolution, which is moving towards digital platforms in terms of commerce and trade. Some of the examples that we can touch on here are digital platforms such as Uber, Airbnb, e-commerce platforms such as Jumia, Takealot, Uber Eats. Some of the characteristics of the digital platforms, particularly in Africa, is that 80% of those digital platforms operating in Africa are actually homegrown. That is, they are domiciled businesses within African countries. The platforms have emerged across several distinct economic activities, and the platforms are generally accessible via web interface and mobile apps. So how has financial service providers reacted to the evolution of trade and commerce from a face-to-face moving towards a digital platform experience? What we've seen is that there's been differences between the reactions of banks, traditional banks, and non-banks, the fintechs, the mobile money operators. We've seen that there's been a need for digital customer due diligence, particularly looking at how financial service providers can integrate with foundational national ID databases to ensure that financial sector integrity is upheld. FSPs have needed to consider the reduction in the cost of onboarding customers through virtual customer onboarding, that is providing virtual access to financial services. It has required a better understanding of customers through data sharing protocols and partnerships. It has led to the need to digitize delivery channels for payments, remittances, savings, credit, and insurance. And we've also seen market entry of digital banks. In South Africa, we have the Discovery Bank and Time Bank, and these are fully digital banks without brick and mortar branches. And now speaking to some of those business models, specifically on fintechs. Fintechs refer to digital technologies that have the potential to transform the provision of financial services. Fintechs take different forms, from a technology incubation app to technology maturity and deployment. Fintechs also span the range of financial service provision capabilities, providing web, mobile, payment, product services, machine learning, making use of digital ID, peer-to-peer lending services. Fintechs typically lack scale on their own, so they typically need to find partnerships, particularly with banks or retailers. And we've seen innovation and competition as a key feature of fintechs, which are available throughout Africa, specifically in South Africa, Kenya, and Nigeria, where those jurisdictions have been identified as fintech hubs in Africa. And then we can also look at another business model, the big tech model. So big tech firms are usually large companies whose primary activity is to provide digital services. Some of these are Apple, Google, Facebook, Tencent, Alibaba. And we're seeing more of these type of big tech companies emerging. So big tech firms enter financial services with the leverage that they could scale up rapidly using their customer data, from the existing business lines that they have. Entry of big tech into financial services has given rise to new challenges, particularly around the concentration of market power and data governance. So if we think about the monopoly power that some of the big tech companies have, which is what this point is referring to. So there are traditional policy concerns such as financial risk, consumer protection, and operational resilience, which would then be relevant. What we've also learned is that the current regulatory framework for financial services usually are difficult to apply to big tech firms. And from an African perspective, it's quite important to start thinking about how to calibrate our regulatory environment to ensure that big tech companies that are playing in Africa are adequately regulated and supervised. We also have the banking as a service model, business model, which is a business to business service allowing banks to lease their infrastructure. Um, BaaS clients are usually retailers, fintech startups, and any organizations wishing to carry out financial operations but do not want to organize their own bank. The BaaS model is similar to renting cloud resources from third-party providers. And the lessee, the BaaS user, chooses what tools to use from the banking infrastructure, which could be payment processing, card issuance, credit facilities, credit management, and real-time cash flows. And then another business model that we've seen that aligns with digital transformation of financial services is the platform banking model. The platform banking model essentially is a digital marketplace owned and operated by a bank or another entity that provides banking and often non-banking services digitally. Platform banking takes two forms. And one of those is banking and financial services as a platform with supporting services. The other is the offering of digital platforms specific to specific industries, which require supporting financial services. So you could think about digital platforms that support agriculture, for instance. In Africa, the agriculture platform banking based services are well established. And these platforms are usually in collaboration with fintech firms. And you would find that fintech firms sometimes also employ this model. This model typically has the advantages of efficiency and convenience because of the partnership that embeds the model itself. So now to look at some of the impact of digitization. From a regulatory perspective, the impact can be quite significant. What we found, particularly in Africa, is that the current regulatory framework is based on a view of the financial services landscape that is increasingly outdated. The regulations cannot be just functionally based. They have to pivot to the models that we're seeing emerge in terms of the business models that I've just described. The landscape is becoming very complex and requires additional skills and additional data. So we also need to think of the regulatory technology that is required to supervise or play the supervisory role that regulators are required to play to ensure that market conduct is upheld. Regulators also need to find balance between competition and stability, market stability. There needs to be an active interaction on a global basis to ensure that the trends around global platforms, big tech firms, and fintech firms are localized and are well understood. There also needs to be an assumed distinction between access to financial services and intergovernmental alignment. And most importantly, there needs to be a balance between financial integrity and financial innovation through the capacity of regulatory sandboxes. And these are some of the potential aspects that the regulatory environment needs to consider. So impact on financial service providers. Some of the opportunities is that there has then been an extended range of market models available. There's been an extended range of technology providers available. We've seen the introduction of new instruments um, that have been introduced into the market. FSPs are able to reduce costs by moving to digital models, and revenues can be increased. There's also the impact on the customer. So if we think about consumers, consumers will be positively impacted through increased competition and choice, increased convenience, extended range of services, possible increased levels of financial inclusion, decreased cost, and increased integration in business cycles, particularly for MSMEs. So if we think about integration into large value chains, um, the process integration, which I mentioned in one of the earlier slides, could be quite impactful from an MSME perspective. And this final slide actually then speaks to some of the negative impact or potential impact to the customer, which includes issues such as data privacy, which is probably the biggest aspect here. The fact that dispute resolution mechanisms might not always be accessible, with the fact that risk assessment of customers is mostly machine learning and data-based, you'd also find that it perpetuates biases and introduces new biases, which then becomes exclusionary. There could also be barriers which could be introduced to increase the digital divide if we consider the differences between consumers in urban versus those that are in rural areas. For benefit of time, I'll just stop the presentation here. Uh, Thank you.